Welcome back. We are now in segment 7.13. This is the last segment in this chapter, and in this segment we'll be discussing about post-sanction issues, right? Regarding term loan disbursement and term loan supervision, monitoring, and follow-up, right? So this book is basically about the appraisal. A term loan, we can segregate into pre-sanction and post-sanction. Okay, so these are two phases involved in a term loan. So in pre-sanction, before the sanction, what are the things that as a credit officer you should be doing? This is all the appraisal stage. Okay, the pre-sanction is the appraisal stage where you look into various factors, the financials of the company, the management, the quality of the management, and various other factors, and determine whether this is the project that is worth financing, right? Whether the bank can take up this project and finance it. Okay, this is the appraisal part. We've seen various aspects that we will be looking into as a banker, right? We will be seeing the managerial appraisal, technical appraisal, industry appraisal, and financial appraisal. Various other we calculated various metrics like the DSCR, break-even analysis, right? Break-even point, IRR. So we've seen those parts. This is the pre-sanction. So based on this appraisal part, we will be deciding whether to sanction or not. Now once the sanction is done, right? This is paperwork, right? This is basically paperwork. The money is not yet released, but once the sanction is done, a bank will be releasing the funds. Okay, so till this part there is no release. This is only the appraisal portion, paperwork. So the loan gets sanctioned. From the point of sanction, the actual disbursement starts. So what are the steps that the banker, as a banker, you should be looking into when dispersing funds to the company? So are you going to disperse as you like? Are there any norms or any guidelines to be followed? Are there any best practices to follow? Right? We look at the disbursement part, and also what is the monitoring and follow-up. Right? This is not a one-time sanction. Okay, sanction could be a one-time event, but the health of the account, if the health of the account is to be ensured, you have to constantly monitor and follow up this particular unit, the unit which have finance. So we'll be looking in this segment about the disbursement, that is one part, and the supervision, monitoring, and the follow-up parts that are applicable to a project. Okay, but this will be a brief segment because the focus of our book is more to the pre-sanction portion. Okay, the pre-sanction part, that is the focus of this book. That is the appraisal stage. The credit appraisal is the major focus of our book. So we'll be restricting ourselves to the pre-sanction, to the pre-sanction part, right? So we discussed all these appraisals, and the financial appraisal will be discussing in detail. But please remember, though the focus of this book is not regarding the post-sanction. Post-sanction is a very important aspect, right? It's just that the scope of this book is limited to the credit appraisal part. But the post-sanction terms, that is the supervision, monitoring, are very, right. They are very important. So when we speak of loan disbursement, the number one point that you have to ensure as a banker is the end user funds, right? So the term loan was sanctioned for some purpose, right? It was sanctioned for some purpose, a specific purpose, like for example to purchase a particular machinery, right, or for a particular project which comprises of land, building, machinery, various other components for a particular purpose. There is a purpose to the term loan. Now it is duty of you as a bank, as a credit officer, to ensure that there is no diversion of funds, in the sense that the funds for which the bank has sanctioned this loan, the purpose for which the funds was sanctioned, has to be adhered to, right? The company should not divert these funds to some other purpose, right? The purpose could be anything. I mean, could be anything. So this company might be having a group firm. So these funds should not be, the funds which is sanctioned for this company should not be diverted to the other firm, or should not be the promoter should not be investing these funds in some real estate, not related to this project, or in some share market, So you have to ensure the end user funds. This is a term that bankers usually see this in banking parlance. Okay, end user funds. What is end user funds? So the purpose for which the loan was sanctioned has to be adhered to. Okay, as a banker, you have to ensure that there is no diversion of funds. Okay, usually this is ensured by not transferring the loan directly to customer's account. So this is a normal practice in banking, that, for example, you have to pay a machinery. The company, you have sanctioned a loan to purchase a machinery. Okay, so this is a 100 lakhs. Okay, this is the cost of machinery. You have sanctioned a term loan. So you have sanctioned 75 lakhs, and the borrower margin will be 25 lakhs. So what you do as a banker, you don't release the 75 lakhs to the customer account. You don't do that, and because once you do that, you have no control about the end user funds. You don't know how the customer is going to use it. So what you do, you don't give that, you don't credit this directly to the customer account. What do? You get the 25 lakhs from the customer. You ask the customer, bring in your margin. So he'll be depositing in his account. Okay, say he's got a current account, he has got this, and he's got this 25 lakhs into this account. Okay, so what you do then, you'll debit the term loan. The loan is for 75 lakhs, right? Then you debit the term loan, right? The term loan account, you will debit the 75 lakhs. So this is fully disbursed. Okay, then you debit this account, this the current account. You draw this 25 lakhs from this current account also. So now this 100 lakhs. For this 100 lakhs, you then issue DD in the name of the supplier, right? When we at no stage we are giving this directly to the customer account. Okay, right? We will debit the term loan account 75 lakhs. We'll take the 25 lakhs from the borrower margin from his account, and for this 100 lakhs we'll issue a DD in the name of the machinery, in the name of the machinery supplier. This will at least ensure that theoretically, there might be some collusion between the company and the equipment supplier, but our field level investigation should reveal those sort of tricks. Okay, if your field level investigations are strong, you'll be having a good idea of who are the sort of suppliers will be who are dealing in these sort of tactics. So, but generally this is the idea. The idea is you don't transfer it to the transfer the loan to the customer account. You issue a DD in favor of the suppliers. Okay, that is the most important term in terms of loan disbursement. Okay, when you disburse, you have to ensure that the end user funds. Also, before disbursement, you have to ensure a couple of things. One, all statutory approvals has to be in place. So term loan usually is given for a project. Okay, so there is a project. Project is for the project to take off, it has to obtain a lot of clearances and approvals. Okay, ultimately this project is operating in an environment. There is a business environment. In this business environment, there are some legal issues. The government has some rules. There will be some local authorities like the panchayats. So there are various approvals to be obtained. So it has to be ensured that all the required statutory approvals, right, such as plan approval and pollution clearance, all obtained before disbursement of the loan. You cannot disperse the loan before these clearances are obtained. Sometimes, if these are not obtained at the time of sanction, maybe you can stipulate a pre-disbursement condition and then sanction the loan, but then you are not going to disperse it. It is a pre-disbursement condition. You can sanction, right, but you're not going to disperse it, right? So you see, if some statutory approval is pending, then you can maybe sanction it. Again, it's a decision to be taken by the banker. Some banks, quite rightly, don't sanction till all the approvals are obtained. It might not be practical in some cases, but as a banker, you can take the call depending on the seriousness of that particular approval, right? Some approvals, like say plan approval, I mean, they are must. You cannot have you cannot in fact start the construction without having a plan approval. So some approvals are very important. Some approvals you can wait. Let's say, for example, inspector of factories clearance is something which you can wait because construction can start, right? Construction can start before getting that clearance. So it's a call you need to take, right? So some conditions or some approvals you can stipulate as a pre-disbursement condition, but nevertheless, before disbursement you have to ensure that all the approvals are obtained. Okay. One more point regarding disbursement is when you sanction this loan for machine or equipment, sometimes managers become very fussy with this regarding to supply. So at the time of sanction, there's a project cost, okay, land, building, machinery, and this machinery, say for example, this is 80 lakhs. And the company has given the break at the time of sanction, right? At the time of preparation of the project report, the company has given a estimate this project is going to incur expenditure of 80 lakhs towards plant and machinery, and this is the list of machines. So the company has given this is the 80 lakhs. It has submitted some quotations. So what are the individual machines to opt up? What are the individual machines the company require? What is the cost of each machine, and who is the supplier the company is planning to buy? Okay, and finally they are at the total of 80 lakhs. Okay, when it comes to disbursement, it takes some time, right? It will take some time for the disbursement to happen. So preparation, when the company prepares the project report and submits to the bank, it might be done in January. But this processing of the loan application, right, the sanction, and then the documentation, it will take time. Finally, disbursement might happen somewhere in April or May. So in this between period, the company might have changed its mind, right? And now it decides to obtain some machinery, a couple of machines from a different supplier, right? So sometimes bankers become very fussy. I mean, they will not approve this. They say because the assessment is done based on this particular quotation, you have to obtain it from that particular supplier only. But please understand that which is the best supplier. This decision, more than the banker, the company is in a better position to take. You are not the best judge of who is the better supplier. If the company feels that it needs to change the supplier, it should be having the freedom to change. So don't be so fussy about the supplier. Okay, the cost, overall cost should not change. Relax. Okay, cannot go beyond 80 lakhs. If it crosses, the borrower has to bring in his own margin, right, and meet that. For say for example, due to this change in a different supplier, this has shot up to 85 lakhs. The additional 5 lakhs has to be brought in by the borrower, but borrower should have the complete freedom to choose the supplier as long as this asset, this equipment is of a standard quality. Okay. Of course, once you sanction it, as a banker, you have to inspect it, right? And also, you preserve all the bills and receipts issued by the supplier. Okay, this is a good banking practice. A common question that as a banker you will be experiencing is whether term loan can be credited to the cash credit account. Usually, this is not allowed. It is not encouraged. But in cases where the sanctioning authority has permitted reimbursement of term loan, you will see this is permitted. Okay, you will see this happens. Okay. So if reimbursement was permitted, you will see this happening. So normally this is not done, but in cases where reimbursement is permitted, maybe you can reimburse that. You can transfer the term loan. You can debit the term loan and credit to the cash credit account. And regarding the margin, we have spoken of it a number of times. It has to be always ensured that the borrower margin is brought up. In chapter 5, when we discussed about item-wise balance sheet, there we discussed about capital. There we had a detailed discussion that it should always be ensured that the borrower's margin is brought in. Okay. So if a loan say 7 crores is sanctioned out of a project cost of 10 crores, that means the borrower margin is 30%. You have to ensure that at all times that borrower margin is 30%, because this loan disbursement will not happen in one day. It will happen over a period of time in phases. Maybe initially the company will come for 1 crore. So initially the company might first of all plan to purchase one machine of costing 50 lakhs. It will not we are not going to release the 7 crores in one go. Okay, in phases we will release. So first the company says we want to purchase a machine of 50 lakhs. So what we'll do, we have to ensure that the 30% margin is always brought in. So what is 30% of this 15 lakhs? So first of all, we have to ensure that the borrower brings his margin of 50 lakhs, and then we'll debit the term loan account for 35 lakhs. Right, term loan account will debit 35 lakhs. Then we club these two and issue a DD for 50 lakhs in the name of the supplier. So now this ensures that the 30% margin is brought in. For the next tranche, right? For next, the company might say we want to purchase another machine for 100 lakhs. Again, what we do? Bring the 30% margin, get the 30 lakhs from the customer. You debit term loan account by 70. Then for 100 lakhs, issue DD in the name of the supplier. So at each and every stage of disbursement, you have to ensure that the borrower margin is brought in proportionally. Okay. Another question you need to address is how much is to be disbursed. Okay, understood that we should not disperse it entire loan in one go. Okay, that's a very foolish way of dispersal. Okay, unless it's for a single machine. Say for example, it's a car loan. Your purchase is for a particular car. Car is costing 5 lakhs. Borrower is bringing in 1 lakh, and you are sanctioned term loan of 4 lakhs. In this case, maybe you can directly get the margin of 1 lakh and you debit the term loan single. This because this is single asset. Okay, these sort of things you can do, but usually in a project, right? Projects happen over a period of time. It takes months or sometimes years. So disbursement will be phase wise. So how much is to be dispersed? Okay, it has to be dispersed in a phased manner. But how are you going to decide how much is to be dispersed in at each stage? What is the basis? When it comes to phase wise disbursement, there are a couple of things you need to keep in mind, right? It should always be based on the progress of work. And this is not something that is just based on the papers submitted by the company. You have to physically visit the site. At the time of disbursement, you have to be very careful. See, site visits can be waived, or you can be liberal with site visits once the production starts. If it's for a renewal or it's for a renewal of CC or enhancement, maybe even then you have to go for the site visit. But maybe that's not so much important as in the case of term loan disbursement stage. When the disbursement takes, that is from the time of sanction to the full disbursement, say 100 lakhs, say 10 crores is the loan, 10 crores is the final sanction. Finally 10 crores you're going to release. In between you're going to release in stages, right? Initially 50 lakhs, another 25 lakhs, another 10 lakhs, another 1 crore. So slowly you'll be building and ultimately put together your disbursed 10 crores. So during this disbursement period, you have to be very careful and ensure that the progress of the work is satisfactory. You cannot disperse as you like. Okay. On one, there are two aspects here. One there is a physical progress. There's a physical progress as far as the implementation is going on, and there is your term loan disbursement. These two should go hand in hand. Okay, there should be a linkage. You cannot disperse the term loan. Your term loan cannot be dispersed up to 90%. Say the term loan is 10 crores. You cannot disperse up to, say, you cannot have a situation where the term loan disperses 90 crores, whereas the physical progress is just 10%. Right? This is a very weird situation, and it is a very it reflects very poorly on the banker and the monitoring. Okay, there should always be a linkage between these two. They should go hand in hand. Okay, if the term loan was dispersed up to 90%, at least the physical progress should be around that, right? 80-90%. You can't have this sort of a disparity. So always you have to ensure that during the disbursement stage, the phase-wise disbursement, you have to ensure the progress of the work. It should be based on the progress of the work. So for each disbursement, say for example, the customer comes with a request of, say the term loan is 10 crore. The company has come and said, first of all, please release 50 lakhs. What do you have to do? First of all, you have to obtain a request letter from the borrower. In this request letter, he'll be mentioning, we want 50 lakhs. This is the purpose for which you're getting. And they'll be telling, this is our margin and this is how you're bringing in the margin. Okay. So we ensure, first of all, that is the first thing you have to ensure. There's a request letter from the customer. The second point you have to ensure is, you have to ensure that the previously disbursed amount was properly utilized. Okay. So, okay, first disbursement, you release 50 lakhs. For the second disbursement, the company has said, please release 100 lakhs. This is for a particular equipment. Now the company has come for another equipment. Please release 100 lakhs. Now you have to ensure, first of all, that whether this 50 lakhs which you have released earlier was properly spent. The purpose for which you have released this 50 lakhs for this particular equipment, was it properly utilized? Was this equipment purchased? Was it installed? Right? Was the margin brought in? So you have to ensure, first of all, the previous disbursement was proper in all respects, and then you can go for the second disbursement. Third, you have to obtain an independent professional certificate from a independent professional like a chartered accountant, and confirm that the required margin has been brought in by the promoters. We have been always stressing on this aspect. Okay, that the envisaged margin of the promoter should always be brought in. So you have to ensure that the proportionate margin. So we have dispersed so far of 50 lakhs. So whether the proportionate margin, so corresponding to 50 lakhs terminal disbursement, maybe the proportionate is 10 lakhs promoter's margin. So whether the margin was brought in. Okay, you have to ensure. So these three you have to ensure at for each and every disbursement. Okay. During project implementation, that is when the project is under construction, you have to be very careful. You have to monitor the physical progress of the project. You have to be careful whether the project is going on smoothly. Okay. So before sanction, when you are appraising the project, the company will be submitting something called schedule of implementation. Okay. So what is the schedule of implementation? The company will be giving a expected schedule of implementation. The company will be saying, this is what we are planning, right? So there will be various entities, there will be various activities involved in a project. Maybe first of all you have to purchase land, then maybe you have to develop land, you have to clear off all the shrubs, then clear the land. Okay, then maybe you have to do some foundation civil works, right? Maybe you have to order some machinery, right? Maybe you have to install them, right? Then maybe you have to purchase, then maybe you have to do some trial runs. So there are various activities that go on before the final DCCO. DCCO is the date of commencement of commercial operation. This is the term used by RBI, so please be very clear with DCCO. DCCO date of commencement of commercial operation. This is the date. This is the expected date when the company is planning to start the commercial operation. So maybe the company has started in Jan 14 and is saying in 5 months time we are going to achieve the DCCO. So activity wise, this is what he's saying. Maybe Jan first week we're going to purchase the land. By the fourth week of Jan we are going to finish developing the land. Then we'll start the foundation work in February. It will take maybe 1 month of this. Okay. Then maybe we'll start ordering the machine in March. The machine will arrive in April, and then we start installing it. We'll conduct the trial runs in the first week of May, and finally in the third week of May maybe we'll start the commercial production. So the company will be giving a schedule, a plan of action, a plan which it expects to achieve the DCCO. Okay, this is not the schedule of implementation. When you're dispersing the term loan, you have to always compare the physical progress. You have to always compare the physical progress vis-a-vis the schedule of implementation, right? The schedule of implementation, you have to compare these two always. Okay. For example, the total implementation, the company has said it will take 12 months, of which land and development work will take 1 month, civil works 8 months, ordering and installation of 2 months, and trial runs of 1 month. Okay, this is what the company has given. So when the actual project implementation commences, you have to always match the actual progress with the submitted schedule. And if there is any delay in implementation, say for example the company said it will complete the civil works by March. By March March end 2014, it will complete civil works and machinery installation is going to start from April. But now it's already April, already May, but still it's already May and still civil works are going on. So there is a delay. Now as a banker, you have to be very concerned, you have to be very careful with the delays, because delays will impact you in two ways. One, there will be a delay means time overrun, which inevitably leads to cost overrun. So whenever there is a delay, it will be leading to increase in cost. So one simple way, one direct one direct reason why costs go up is labor cost. So initially you have to complete it in 5 months. Now it's taking 7 months. So for this extra 2 months you have to pay labor, right? Labor is working for this extra 2 months, so that is one cost that goes up. As time goes, your material cost also goes up. What was the cost of steel 1 year back? It will change after 1 month, one year. Okay. So there are a lot of expenses that go up with delay. Okay. So this will impact the project cost. Originally you said the project cost was 100 crores, of which you sanctioned 80 crores as a banker. The company said will bring in a margin of 20 crores. And then as a banker, you are satisfied with the promoter's margin to bring in 20 crores. You are convinced that the promoter was sound enough to bring 20 crores. Now the project cost has gone up to 125 crores. Now as a banker, you said any cost overrun the borrowers have to meet. You sanction only 80 crores. So the remaining 25 plus the 20 original 20 to put together 45 the promoters have to bring in. Are the promoters capable of bringing this additional 25 crores? If not, the project will be stopped, right? If not, the project will be stopped and your funds are going to be blocked. When is this repayment going to come in? As a banker, your loan is going to be repaid only when the project gets completed, it starts operating, profits are generated, and then your loan gets repaid. If the project gets halted midway, your funds are blocked. This account becomes there's a risk of this account becoming NPA, and that is the second reason why you have to be careful. One is the cost overrun. Second is there is a risk of NPA. Not just because of this reason, but also what RBI says is even if the loan repayment is not affected, even if the company happens to repay promptly, if there is a delay of more than 6 months from envisaged DCCO, the account has to be classified as NPA. This is as by RBI IRAC norms. Income recognition and asset classification, the RBI has a guideline that if the project implementation gets delayed more than 6 months, I'm speaking of non-infrastructure projects, okay? In infrastructure projects, you have a slightly higher period, but in case of non-infrastructure projects, if the actual implementation is delayed by more than 6 months from the envisaged schedule, so you originally just said by May 2014 will achieve DCCO, right? So by November 6 months gets completed, right? If it is December and still the project is not completed, DCCO is not achieved, you have to classify this as NPA, even though you are servicing interest, okay? Even though you are servicing interest promptly during this all this period, but even then the account has to be classified as NPA. This is as per the RBI now. So you have to be very careful as a banker regarding the project implementation. When the project is getting delayed 2 months, 3 months, 4 months, you have to be very careful. See, delay will be there. Delay is inevitable. Okay, everything doesn't go as per plan. Everything doesn't go as per plan. There will be delay. But if delay gets close to that 6 months mark, you have to be very careful because NPA norms will be applicable. Okay, so you have to closely monitor the project implementation, ensure that the account doesn't slip into substandard category. So in order to have that close monitoring, banks usually call for information from the company during the implementation stage. Okay, so during the implementation stage, banks call for some information periodically, maybe once in every 2 weeks or once in every 1 month. They will be asking companies to submit information. Usually this is in this format. Okay, the format might vary from bank to bank, but this is usually the format. The format what is a very simple format. What it actually says is what is the envisaged project cost, right? Say for example the company has envisaged a project cost of original. This is the plan, okay, and we said we'll meet a cost of 20 crores and bank sanction 80 crores. This was the plan. So 100 crores was planned to be met from promoter sources of 20 crores and term loan of 80 crores. This is envisaged. Say this is done in sanction is done in Jan, and it will take 6 months. So June 2014 the project should be completed. This is the schedule. Okay. Now say for example we are in April, midway to the project. Okay. So what you do in April, you ask the company to submit this information. So till April, so what is the amount you have spent? So the company will say maybe we have spent some 60 crores on this project. So it will item wise, it will say land maybe we have spent 5 crores, civil work some 20 crores has gone in, machinery some another 20 crores. So the company will be giving some item wise breakup how the 60 crores was spent. Okay, and it will also tell how the 60 crores was met. So originally if you see the promoter's margin was 20%. Okay, anyways, so the company should have brought in 20% to ensure proportionate margin, 20% here also, right? That means 12 crores. For 48, ideally 48 crores term loan and 12 crores capital. But maybe the company has brought only 8 crores. We don't know, right? Maybe the company has brought in only 8 crores, and maybe it has used up some internal accruals, some 2 crores and some unsecured 2 crores. This is how the 12 crores was made, and a term loan disbursed of 48 crores. So put together 60 crores. So as a banker, you should be knowing how this 60 crores was met, whether the envisaged margin was brought in or not. Okay. So this amount disbursed till date, that is that 48 crores, the 48 crores which has been disbursed till date. So into where did this 48 crores go? 48 crores go item wise. So this also you obtain. So this is the information you call for from a company during the implementation stage. Maybe once in 2 weeks or once every month you get information from the company, right? Because during implementation stage you'll be very careful. You have to be constantly monitoring the progress of the project. So get this information as frequently as possible, and always try to ensure whether, first of all, whether the project is on schedule. So compare this with the compare the physical progress with the envisaged schedule of implementation, and ensure this is on schedule, right? If it is off track, you have to call for the reasons and ensure that the NP announced doesn't become applicable. Okay. The second thing, you have to ensure that the capital, the envisaged promoter's contribution, is proportionately brought in. Okay, and you have to track if there is any cost overrun. This is also a good place to track the cost overrun. Okay. So originally you said it was 100 crores. In January it was say 100 crores. The project should have been completed by June. So now already May has come, just 1 month from the scheduled completion of the project, but you have spent only 60 crores. So just 60% of the project is completed till May, and there is 1 more month, just 1 more month for the completion of the project, and still we are in this civil works. Still we not yet come into the machinery part. So this is a very likely scenario that the project cost will shoot up. This looks like a scenario where project cost is going to come. First of all, there is a time overrun, right? Inevitably there will be a cost overrun also. So how you will identify whether there is a cost overrun? So initially the company said will incur 5 crores, 10 crores, 20 crores, another 20 crores. Right? This is how the company said. Now you look at the amount spent till date. Maybe the company now says we actually incurred 6 crores for land. Civil works, it has gone up by 12 crores. Right? Machinery, maybe it has stuck to the original cost. Imported machinery has gone up by some 25 crores due to fluctuation. So you have to do the comparison between the envisaged project item wise cost and the actual amount spent. Okay. So there are a lot of things to look in this during the implementation stage. Okay, you have to ensure that the project is not off track. Right, it has to be on schedule, and there is no cost overrun, and the proportionate margin is being brought in. And it is not just paperwork. Okay, these are not just papers submitted by the company. You have to physically inspect the project. Right. You have to go to the site. You or your inspection team has to be on the field, gauging the actual progress of the project. Okay, disbursement should never be made on the submitted papers alone. Right, site visit should be mandated during the disbursement stage. Okay, once the operations commence, maybe you can be a bit liberal, but during the implementation stage, you have to make frequent visits and ensure that the actual progress is in line with the schedule, in line with the implementation schedule envisaged. Okay, and if there is substantial delay, you have to be bringing it to the notice of the concerned authorities, right, and ensure that the the account doesn't become NPA, right? So always call for a periodic information. Get it maybe once in 2 weeks or once in a month. You call for the information. The borrower may always be reluctant to furnish this information that frequently, but as a banker you have to be very careful during the disbursement stage, because this is where you ensure the end use of funds. This is where you ensure that the project is on track. Okay, so you have to be very careful in monitoring the progress of the project during the implementation. So as you go on releasing the disbursements, say 10 crores loan, you have discussed 1 crore initially, 2 crores, then another 5 crores, another 1 crore. So finally you have come to 9 crores. Okay. So when it comes to the last disbursement, right, when at the time of release of last tranche, you have to ensure that the project implementation is completed. Right. So final disbursement should always be made after the project implementation is completed. It will be a very funny scenario where your loan is disbursed completely 100%, but project implementation is still going on. You should not get into that sort of a situation. It means that as a banker you have not done your duty. Term loan is 10 crores. Right? You have disbursed entirely 10 crores. Totally you have disbursed. Whereas if you go to the physical progress, it's just 70% completed. Now you should never get into these sort of scenarios. Okay. The final disbursement should always be made, because this means the promoter's margin has not been brought in, or there is a cost overrun. So if the promoter's margin was brought in proportionately, by the time you release your entire term loan, the promoters must also have brought in his margin. So the project should have been completed 100% by the time. But still project is only 70% completed, which means you have disbursed your entire term loan, but borrower's margin is not brought in. Okay, so never do this. Okay, the final disbursement should always be made when the project implementation is completed. Okay, and then during implementation stage, you have to get periodical progress reports on the project. These reports can be submitted by engineer report. He certifies what is the work done, what completed so far. You can get a certification from the chartered accountant, what is the amount spent so far. Okay, so where various independent professionals, you should be getting these periodical reports. Okay, in major projects there will be something called lender's independent engineer. Okay, so this LIE will be furnishing maybe quarterly reports. Okay, he'll be submitting the periodical progress reports. Large projects are usually consortium accounts. Okay, so there will be a lender's independent engineer appointed for the purpose of tracking the progress in the project. So every quarter, or maybe once in 1 or 2 months, he'll be submitting the periodic progress reports to the consortium. So that's also a good place to, since that is an independent report, that's a good place to look at the whether the progress is going as per the schedule or not. So when it's a large project, usually it will be a consortium finance. So when there is more than one bank that takes up the loan portion, right? That could be either consortium or multiple banking. We'll be discussing the difference between consortium and multiple banking in a later chapter. But when more than one bank sanctions the unit, it's a very powerful scenario for the bankers. Okay, it's a very powerful scenario. So you can bring pressure on the borrower. So conduct joint unit visits. Okay. If any deviation is then apply pressure to the borrower, right? You should use that influence as a group to pressurize the borrower to fall in line if there are any deviations observed. Okay, and in consortium finance, please always remember that it's advisable to commence disbursement only after the entire debt portion is tied up. So the project cost is 250 crores, of which the term loan portion is 200 crores. This 200 crores is tied up by 4 banks. Okay, bank 1, bank 2, bank 3, bank 4. Each one has sanctioned 50 crores. Okay, so each bank. So the company has approached 4 banks for 50 crores each. 2 banks have sanctioned so far. So 100 crores has been tied up. Out of 200 crores term loan, 100 crores has been tied up. So still the company is pursuing with the other 2 banks. This is under process. Now these 2 banks which are sanctioned should wait for the sanction of these 2 banks. Theoretically, that is advisable. Okay, it's always advisable to commence disbursement, your bank's disbursement, only after the tie-up of the entire debt portion and completion of joint documentation. Okay, let us not take names, but you are aware. If you are in the banking sector, you are aware of maybe 3 to 4 years back in the power sector, there were companies, very big power projects have come up, messaging a lot of finance from consortiums. Okay, I think a couple of banks already dispersed their share of the term loan pending sanction of the other banks, and ultimately the other banks didn't tie up. So these banks ended up sanctioning and dispersing their share, whereas the other banks had not sanctioned because the power sector was overfunded and some banks decided not to take exposure. So these are the sort of troubles you can run into. Okay, so please always ensure to the maximum possible extent that you have to release your share of term loan after tie-up of the entire debt portion. Sometimes banks do that. Sometimes banks release based on individual documentation pending this total tie-up. They do. It occurs in practice, but as far as possible, try to avoid it. So that is the loan disbursement part. Okay, what are the steps you need to be taking during the disbursement period when the funds are being released? Okay, once the funds are released, the project is completed, project has started operation. So you have to then monitor the account. Okay, the health of the account is to be monitored by regular follow-up. Please note that this is a journey, right? Your job as a credit officer doesn't end with the sanction, right? The real responsibility actually begins with the sanction. Credit appraisal is the first part. It's just the first part in a long journey. As we said earlier, this book focuses on the credit appraisal part, but please understand that credit monitoring is a very, very crucial part of advances, right? So banks will be having separate department for advances, which looks after the appraisal portion and sanction. But then there will be another department called credit monitoring, a very important department which monitors the health of the accounts. Okay, so the advances team deal with the credit appraisal, and this book is basically targeted to those departments. But there is another segment called the credit monitoring. Though this book is not focusing on this, but please understand this is a very important function. In fact, between these two, which is more important? Many say this is the most important because this is the technical part, to analyze the financials and all. But then experienced bankers would say this is the most important department, more than the sanctioning department. Credit monitoring is the most important department. To quote Mrs. Ranjana Kumar, who was a former chairperson of Indian Bank, right, and also of NABARD, she said these golden words in an interview. What she said was a second grade appraisal, yeah, right? A second grade appraisal followed by first grade monitoring can still help an account to be healthy, right? Maybe you didn't do the appraisal correctly. Maybe the officer involved and maybe the executives involved didn't do a proper job in appraisal. It was a second grade job. Okay, it was not done perfectly. But if this is followed up by a top class monitoring, the account can still be healthy. Whereas a first grade appraisal, your appraisal was top class, right? Top class appraisal, a top class job done by the credit appraisal team. But if it is followed up by second grade monitoring, this account will definitely end up in trouble. So as a credit officer, please always remember these golden words. Okay, these are very important. These are very crucial words, right? This highlights the importance of credit monitoring. You can get away with the account. An account can be saved if your monitoring is healthy. Even if an appraisal goes wrong, there are some even if there are some errors in the appraisal, but if your monitoring is proper, the account can be saved. But if your appraisal is top class but monitoring is not that good, account will ultimately end up being in problem. Okay, so work doesn't end up in your work doesn't end in sanctioning of the account. Okay, it is where it is actually where your work starts. Okay, it's an ongoing process. Loan monitoring is an ongoing process. Even after the project is completed, even after DCCO is achieved, commercial operations commence, you have to be monitoring the advance. What should be monitoring? You'll be monitoring the production, whether company is producing the envisaged quantity. What is the turnover the company is achieving? What is the profitability it is achieving? Whether its profitability is sufficient to repay the loan obligation. So you have to obtain periodical reports. Usually banks sanction term loan and working capital, right? Both. So working capital you'll be renewing every year. Once in every year you'll be renewing. So sometimes banks, even if they don't touch the account for 1 year, this account will come back after 1 year. So maybe at the time of renewal, if not enhancement, at the time of renewal, you can at least review this term loan and see whether the progress, what is the status of the term loan, whether this project was completed, whether the margin was brought in, and at least at the time of renewal you can do. But if you sanction only term loan, you have to be very careful, because if you don't touch it, it will never come to you. At least in the case of working capital, it will come after 1 year. In the case of that, in form of renewal, then you can also parallelly see what is the status of term loan. But if you sanction only term loan with no working capital, this doesn't come to you. Banks have some norms in these cases called review of standalone term loan. So standalone term loans have to be reviewed based on some calendar. Maybe once in 6 months or 1 year they have to do, but this is not usually done, because based on the work pressure, you focus more on the working capital, because this becomes NPA if not renewed within 3 months or 6 months as per the bank norms. So you'll be focusing more on these accounts. Sometimes standalone term loans gets neglected, even though the policy states you have to review the standalone term loans at least once in a year. You'll be skipping them. You'll be just monitoring the overages as a whole. What are the OG accounts? If the account is overdue, you'll be following with the company for recovery of the overdues. But monitoring this account, the status of the project, is something that is missed in case of standalone. So please be very careful. In case of standalone term loans, you have to be more careful, because it's not going to come to you as in the case of working capital accounts. So please undertake periodical review and ensure that the account is not at risk. In case of term loans, a lot of frauds can happen. Okay, we are not going to list out all the frauds that happen. But customers are innovative; they'll be coming up with new frauds. But just to give an example, this was a real life case where a project cost was 500 crores. Let us say the project cost was 500 lakhs, of which the promoter's margin was 100 lakhs. So what the borrower has done was, prior to approaching the bank for the loan, right, he set up three other firms, right? These three other firms were his close relatives. So three other firms by his close associates. Okay, let's call them BCD. Okay, so A is this firm, right? He promoted three other firms, not in his name, but in his name of his close associates, and they were into various other activities. If I remember correctly, one was into poultry, and so on, right? The three different activities, and working capital limits were sanctioned to these firms. So these firms applied for working capital limits, not term loans. Okay, because in term loans you have to show proof of this asset creation. If you are sanctioned for term loan for a particular equipment, you have to show proof of this. You have to show when the bank officer comes to physically inspect the asset, you have to show that the asset was daily created. So they didn't apply for term loans. These three firms applied for working capital limits and they were sanctioned from some other bank. Okay, So then what the promoter did was he promoted in his name. Then he promoted another company. So in his name he set up another company, and this he posed as a civil construction firm. Okay, as a civil construction firm, and the current account of this firm was at some other bank. Now what BCD did was, these three firms, they availed the services of E. Right, BCD, they availed the services of E because he was a civil. They was posing as a firm that is into civil construction. So they obtained finance from this firm, right, for construction of sheds. Actually, there was no construction, but they availed the services, and so what happened? The money was debited from the working capital limit of these three firms, and it got credited into this account. And this is in the name of the proprietor. So the proprietor had got some funds in the eyes of the banker. So and this E was then, so this amount in E was then routed through some various maze of transactions, a maze of family transactions and various other accounts, and finally it came in as form of a promoter's margin for A. Remember, A has to bring in the 100 lakhs as his contribution for this project, right? This project of 500 lakhs, he has to bring in a margin of 100 lakhs. So without bringing a single rupee out of this margin, this is how he managed. Okay, three firms he promoted. He got three firms promoted by his associates, right? And they availed the services of some other firm. This E was promoted by himself, and they availed the services. So the funds got transferred from this bank to this bank, into this account, from these accounts into this account, and then as margin, and then they went into the various personal accounts, and then they came back into this account. Then they came back as promoter's margin. So if you are a banker of this firm, when you see bring in your margin of 100 lakhs, you see you don't suspect anything, because these were getting from family members. He says, my family members has some funds and we are getting it. Okay, so this is how fraud has happened. There are various other instances where fraud happened in term loan. You have to be very careful. If you remember, in an earlier chapter we spoke of another fraud where the company gets in hand in glove with the equipment supplier, and quotations get issued for the higher amount. We discussed that sort of fraud also. So there will be various frauds, right? Companies will be innovative. You have to be. The only thing you can do as a banker is you should be vigilant. Okay, as a credit officer you should always be, because borrowers will be coming up with new and new innovative ways to cheat the bank. You have to be vigilant. Okay, of course this is not a book to be dealing with an exhaustive coverage of fraud. That is not our intention. But when we are discussing term loans, you have to be very careful that the promoter margin, right? Promoter margin has to be brought in, and promoters try to, in many cases, right, promoters try to get around this. They don't want to bring in their margin, but they want to avail the term loan. Don't always rely on the certification by chartered accountant that which certifies that promoters have brought in so and so funds. So you do your own inquiries also. You have to verify through some independent means and ensure that this is really the case. Okay, please be vigilant. As credit officers, you have to be vigilant, especially in the case of term loans. Working capital is a different story. Maybe of the two, you can be a bit less vigilant there, because at least you have a physical stock there. Okay. So a bank, because working capital is usually against security, against physical stock, right? It's usually backed by drawing power. So in that sense, it is a bit all right. But in case of term loan, please be very careful. Okay, term loan. I'm not saying it's risky. I don't want to scare you, but you have to be vigilant. Okay, in term loans, you always have to be vigilant, because there are various stages. Okay, starting from the appraisal stage to the disbursement stage and the monitoring stage, you have to be, there are various stages and all. You have to be vigilant, right? So in the next chapter, we'll be starting discussion on the working capital. But before that, in the next segment, we'll be taking a small exercise to see how far you have grasped the various concepts we discussed in the chapter on term loans. Okay, see you then.